Welcome to today's Explainer. We're diving right into a financial strategy that's specifically designed to protect your capital, while, still steadily growing it. If you've been on the hunt for that elusive middle ground in investing, that sweet spot where your money isn't just sitting there collecting dust, but it also isn't keeping you up at night with those wild market swings, well, you're in exactly the right place.
So, how exactly do you earn equity-like tax benefits with debt-like stability? It's the ultimate modern investor's dilemma, right? For most of us, dumping money into the stock market means strapping in for an absolute roller coaster ride. But on the flip side, leaving it in a basic bank account, that just means watching inflation slowly eat away at your purchasing power. So what if there was a way to capture the tax efficiency of the stock market without actually taking on all that terrifying directional risk? Here is our agenda for today. Section 1. Decoding Arbitrage Mutual Funds. Section 2. Inside Nippon India Arbitrage. Section 3. Risk metrics and volatility. Section 4. Assessing long-term capital growth. Section 5. Peer and benchmark comparisons. And finally, Section 6. Key advantages and risks. Let's get right into it.
Section 1. Decoding Arbitrage Mutual Funds.
Okay, so unlike standard equity funds that completely rely on a stock's price going up over time, this strategy actually benefits from market volatility. It's built to capture tiny pricing inefficiencies. Think of it like this. Imagine buying an apple at a local market for $1, and then simultaneously selling that exact same apple to someone in the next town over for $1.05. You don't really care if the global price of apples completely crashes tomorrow, right? Because you've already locked in that 5-cent profit. And honestly, that is the core of arbitrage. By buying the physical shares in the cash market and literally at the same time selling a futures contract for those exact same shares in the derivatives market, the fund manager locks in what we call a gross basis spread. Because these two prices absolutely have to mathematically converge on the expiry date of the contract, directional risk is basically wiped out. You aren't betting on the market going up at all, you're just capturing the spread between today's spot price and tomorrow's guaranteed future price.
This really perfectly visualizes a purely market-neutral strategy. Whether the market bull is charging to all-time highs or the bear attacks and sends stocks plummeting, your specific equity risk is entirely hedged out. The fund is taking these offsetting positions simultaneously. Basically, as long as there's volatility and enough trading volume, arbitrage opportunities are going to exist.
Section 2. Inside Nippon India Arbitrage.
Look at that number. Managing a massive 16,638 crores in assets under management as of mid-2026. This isn't some niche experimental strategy. That sheer size really showcases a highly institutionalized approach to capturing those basis spreads. This fund actually launched way back in 2010, and it relies on a 5-member professional investment team. They use these complex quantitative execution algorithms just to manage this massive corpus efficiently.
Now, because the portfolio takes these offsetting positions, the equity exposures can mathematically exceed 100% on paper. But if you're a conservative investor, the really crucial takeaway here is that massive 97.44% concentration in large-cap stocks. They are hyper-focused on the biggest, most liquid companies in India, think HDFC, Reliance, Axis Bank. This makes sure that when the fund managers need to execute literally thousands of trades to capture those tiny spreads, they can get in and out of the market instantly without shifting the underlying stock price.
Moving right along to Section 3, Risk Metrics and Volatility. So this table right here, it's essentially the fund's safety rating. If you're a beginner trying to figure out long-term capital growth and risk, these are absolutely the numbers you want to be looking at. Check out the Sharpe ratio. At 1.97, it significantly beats the category average of 0.81. And since the Sharpe ratio measures risk-adjusted returns, that means for every unit of risk this fund takes, it's delivering exceptional returns compared to its peers. Plus, you've got a beta of 0.65, meaning it's way less volatile than the broader market. And thanks to those quantitative models we mentioned earlier, they also strive to generate positive alpha, grinding out returns beyond what you'd normally expect for such an ultra-low risk level.
The really crucial point here is teaching yourself how to actually read these metrics. A tiny 0.52% standard deviation proves that this fund acts more like a shock absorber than a roller coaster. To put that into perspective for you, a standard long-only large-cap equity portfolio usually has a standard deviation somewhere between 14 to 18%. So by hovering at roughly 0.5%, Nippon India Arbitrage is giving you an incredibly stable ride. It's honestly an ideal harbor for your emergency corpus when the markets get choppy.
Section 4. Assessing long-term capital growth. Let's look at this timeline to see how this actually builds compounding efficiency. If you stay invested for just 15 days, boom, you avoid the exit loads. Hold for over a year, you unlock favorable long-term capital gains tax, which is currently sitting at 12.5% for gains over 1.25 locks. That effectively gives this heavily debt-like instrument amazing equity-like tax benefits. And looking at the history, it takes exactly 9 years and 4 months to hit that fund multiplier milestone and double your initial capital. It's just a slow, steady, and remarkably predictable compounding machine.
Section 5. Peer and benchmark comparisons.
So, when we contrast Nippon India against its major peer funds, it sits very comfortably in the top tier of institutional choices. Now, Kotak might have a larger AUM, sure, but Nippon India maintains a purely low-risk profile across the board. Its size, over 16,000 crores, is perfectly balanced. It's large enough to negotiate better trading costs, but still nimble enough to efficiently capture those super-fleeting arbitrage spreads before they vanish.
And when we contrast these results against its primary benchmark over the long haul, Nippon India actually edges out the Nifty 50 Arbitrage Index. It might slightly lag in that very short one-year window, but look closely at the 5-year and since inception marks. The direct plan has delivered a rock-steady 7.07% compound annual growth rate since its inception. That comfortably beats the benchmark's 6.19%. It really just proves that the management team's algorithms are successfully grinding out that alpha over the long term.
Which brings us to Section 6, Key Advantages and Risks.
When you're weighing the final verdict, it really comes down to a distinct trade-off. On the advantage side, you are getting incredible tax efficiency. Because the fund holds over 65% in equities, it's taxed as an equity fund instead of a debt fund. Plus, you get supreme safety and stability, fully hedged against market drops. But on the flip side, you do have to accept higher expense ratios. The fund is executing thousands of trades every single day, so costs add up, pushing the regular plan's expense ratio to around 0.85%. And remember, the absolute biggest risk here isn't a market crash. It's a completely flat market where those price gaps between cash and futures completely dry up.
I'll leave you with this final question to consider about your own portfolio. Is your emergency fund currently working this efficiently, or is it just sitting there losing value to inflation in a standard savings account? Could a low volatility, tax-efficient arbitrage fund be the Goldilocks solution you've actually been looking for? Thank you so much for joining today's explainer, and definitely keep questioning how your money works for you.